Good afternoon, everyone. Welcome to NITYA Roundup May 2022 edition. In today's roundup, I am joined with my colleague Aasmee, who will be taking some part of the session. So, starting with, we will be covering recent changes and news that have come up in last month. And under GST, as we all know, detention and seizure of goods was quite surprising that the department is seizing the goods basis some clerical errors only. However, over the period of time, various jurisprudence have come up where the court have allowed the relief to the taxpayer. So we will be covering in that part. Then we will be cover key rulings that have come up in last month. Then we close with the synopsis. And thereafter we will have live Q&A round where the interested participant can ask their question and we will be answering them. So starting with first part of the today's session, that is recent changes. Let me take you through the first custom changes. So as we all know, EPCG scheme enables an importer to import the capital goods at zero rate of custom duty. The procedural aspects, the changes have been made in procedural aspect of the EPCG scheme, starting with the timelines. So earlier the taxpayer could file the exemption for the EO period for the first law within 3 months. And if the same is not granted, then he has to pay the custom duty with interest. Now the same has been revised, and he can file within 6 months with no late fee, and after 6 months till 6 years with the late fee of 10,000 per authorization, and thereafter after 6 years with the late fee of 10,000 plus additional fee of 5,000. So in fact, what the changes have been made before the taxpayer could file within 3 months for the extension period. However, now he could file beyond 6 years also with the payment of late fee. And further, if the RA does not grant any extension period, then he has to pay the custom duty with interest within 6 months from the expiry of first law. Coming to next thing, there has been extended the time limits for the fulfillment of reporting required under EO obligation, and that has been extended from the April 30 to the June 30 of the succeeding financial year. Moving forward, the timelines for the application for extension of EO period are also revised. Earlier, the taxpayer can ask for the extension within 3 months, and that could be extended for further 3 months. Now the same has been revised. And if the taxpayer files for the extension within 6 months, then no late fee will be payable. If we file after 6 months and up to 8 years, then late fee of 10,000 is required to be paid. And if we file after 8 years, then late fee of 10,000 plus additional late fee of 5,000 is required to be paid. Moving to next thing, in case authorization fails to fulfill its obligation, then he has to pay the custom duty. Earlier, it could utilize the credit scheme for the payment of such custom duty. Now, the same has been removed. In other words, the authorization holder cannot use the credit scheme for the payment of custom duty at the time of exit. Coming to GST change, so the new functionality has now been made available on the GST portal. So as you can see in your screen, the taxpayer has the facility to view its annual aggregate turnover for the previous financial year and aggregate turnover for the current financial year based on the return filed till date. He has also the option to update the turnover of previous financial year twice within the month of May 2022. Thereafter, the figure will be freezed and will be sent for jurisdictional officer for his review. So this functionality has not much implication from the point of view of taxpayer, but it can be used by the department for tracking audit selection or for seeing the invoice applicability. And this is more from the perspective of the department than for the taxpayer. Moving to next part, recent news. So there are CBIC report which says that the council may do away with 5% rate and we moved to 8% rate. Now the center recently announced that council is not planning to raise tax from 5% to 8%. Further, the businesses need to gear up to face stiff queries from the GST authority as they begin scrutiny of returns, and the department may use artificial intelligence risk-based parameter to select the cases for scrutiny. CBIC has also proposed the mandatory GST scrutiny on quarterly basis. They have also issued SOP for their field officer. Yes, as levy of compensation is set to be expiring financial year 2026, the government is planning to subsume its rate into GST rate specifically for same good to keep compensating the states. Further, the Chief Justice of India, N.V. Ramanam, said that he is considering to set up a special bench to hear matters related with tribunals, their functioning and appointments, and applicable GST rate on online gaming is online dispute. The council has given the task to the group of ministers to look into this, and they will likely suggest the flat rate of 28% for such online games. So, moving to next topic of detention and seizure of goods in transit. So, as we all know, half of the litigation under GST regime revolves around e-way issues. The department is categorically seizing or retaining the goods of the taxpayer based on some clerical or procedural error, and then demanding the full tax, interest, and penalty in order to release the goods. However, the High Court in recent months or past have allowed the relief to the taxpayer where the intent of the taxpayer was not to evade tax. So before coming into that, we would like you all to take through the poll that we ran on social media site, where we asked from the audience whether is it legally correct to detain goods in transit for inadvertent errors in e-way bills. So there, the 22% audience says it is legally correct, 72% says it is not, and 6% was not sure about the answer. While most of us feels that it is legally not correct to retain such good, however, the GST provision does not bar such power of the field officer to retain such goods in inadvertent cases also. Under section 129, the field officer has enough power to detain such good in minor discrepancies in the documents of e-way bill also. While the field officer has power, the CBIC has also issued a circular specifying some instances where the department may not initiate the proceeding under section 129. The cases deal with clerical mistakes only, and just like spelling mistake in the name of the consignor or consignee, discrepancy in invoice number. However, the court have allowed the benefit to the taxpayer even their case does not fall under those specified cases also. So coming into that, recently Smart Roofing Private Limited, the petitioner consigned the goods from his place to his new place of business. However, the e-way bill contained incorrect address of the consignee. Here the High Court held that it was only a procedure breach and the intent of the taxpayer was not to evade tax. Therefore, the such retention should not be done to the taxpayer. Basis that penalty order was quashed. So this is not the one ruling. There are many other rulings as well. So in another ruling, there was a mismatch in invoice date and e-way bill date. The court herein again granted the relief to the taxpayer, seeing that the mistake was only due to typographical errors. In another one such case, there was mismatch in actual quantity. Herein again, the court granted relief to the taxpayer, seeing that the difference was very small when compared to tax already paid. There was also another case where the e-way bill got expired just prior to date of entry state. Herein again, court granted the relief to the bona fide taxpayer. There are also many other cases as well, wherein the court granted the relief to the taxpayer, seeing that the intention of the taxpayer was not to evade tax or the error was inadvertent only. So, while the court has given such favorable judgment, but there is no change in the approach of the field officer, and they will continue to detain such goods in case of minor errors also. And as of now, the taxpayer should try to avoid such errors only. And since if the goods were not and since the goods can be detained by the taxpayer, and they have to pay the penalty to release the such goods. Also, while in most cases, while in future we can hope that there can be change in the power of the taxpayer, power of the of field officer. However, as of now, there is no change, and the taxpayer should avoid such errors only to ensure the smooth running of their business. With this, I request Aasmee to take the forward session. Over to you, Aasmee.
Thank you so much, Sarita, for enlightening everyone on the developing jurisprudence and legal matters. And yes, of course, while the high courts have been granting favorable rulings in respect of these matters, but since field officers' approach has been same and they have been detaining goods, and ultimately taxpayers have to pay penalty to get the goods released, so at the first place they should try to avoid making such errors only. Now, moving to the next part of our webinar, wherein we have covered all the recent rulings that have come in past 1 month. So, starting with Supreme Court judgment in the case of Billerwood Chemicals. So, in this case, the issue was with respect to interest rate on delay in granting of refund. So, the assessee had filed for refund of export of goods. In that case, there was a delay from the department's side for 90 to 120 days in granting of refund. So the assessee approached for the interest rate. So the High Court allowed the interest rate at the rate of 9%, which was over and above the rate that was given in the statute, that is 6%. So the department filed appeal with the Supreme Court. So the Supreme Court has held in this case that wherever the statute provides for an interest rate for delay in refund, in that case, interest should be paid on the basis of the statute. So if it's 6%, it should be 6% only. In case the statute is silent on payment of interest or on the rate of interest, in that case, high courts can pay the interest at reasonable basis on the equitable grounds. There was an interesting observation by the Supreme Court in respect of inordinate delays. So the Supreme Court said that even if statute provides for any interest rate, if there is an inordinate delay by the department in grant of refund, in that case, the High Court can choose to grant interest at higher rate. While we agree with the first two parts of the judgment, in respect of inordinate delay, we believe that since the statute does not provide for the same, it would be very subjective as to what amounts to inordinate delay. So in our view, whether it's a delay of 2 days or 2 years, the interest should be granted as per the statute rate only. The assessee would anyways be compensated for the time period, but interest rate should not be granted at a higher rate. Moving to the High Court rulings, so in this recent case of Calcutta High Court, this was a Trandon matter. So the taxpayer was subjected to multiple investigations in respect of the same Trandon. So earlier the CGST department investigated its Trandon. Then the DGGI started investigations in respect of the Trandon. And then the audit department audit wing also issued a spot memo. So the court held that none of the proceedings, either by CGST department or the DGGI, were taken to a logical end, and so the petitioner was dealt in a very unfair manner. So it quashed the memo. So in this respect, we would like to highlight that while the law itself does not put bar on the parallel proceedings, it only bars under section 62B for the parallel proceedings on the same subject matter by state and central. And in this case, these were central authorities only. So while strictly there is no bar, But as far as the settled jurisprudence in this regard is concerned, this is an unfair practice that on the same subject matter, different wings of the department is raising investigation. So to that extent, this ruling is correctly held that it should not be done to the petitioner. Moving to the Madras High Court judgment in the case of petrol explosives. So this was again the matter of Tranvan. In this case, the petitioner's factory had met with a fire accident due to which its factory was closed for about 2 years. And so it opened the business in August 2018 when the timelines for filing of Tranvan was gone. So he could not transit his credits. So the court, again, like many other matters, it held that because of technical difficulties, the substantive benefit should not be denied. And this was a very genuine difficulty for the taxpayer. So the court directed revenue to credit the amount in electronic cash ledger or grant the same by way of electronic cash refund. While there have been many judgments in respect of transitional credit issues wherein high courts have been continuously granting relief or favorable judgments for the taxpayers, in this case, we would like to highlight that court has gone way beyond the equity grounds as well, because if it had to restore the taxpayer on the same position, it would have granted credit in GSTR 3B. But by granting a cash refund, they have gone even beyond the equitable grounds. Next is the case of ITEC Plus, a Gujarat High Court judgment. So this was a case of an inadvertently claimed refund. So what happened was the assessee imported inputs under advance authorization. So it imported inputs duty free, and then it exported the goods on payment of GST and claimed refund. Under Rule 9610, there is a specific bar that if you have imported inputs under advance authorization, then export cannot be made on payment of GST and refund cannot be claimed. So on realizing this error, petitioner repaid the refund along with the interest and filed for the refund of the credit utilized. So the department was denying, saying that there is no provision for the recredit of ITC. The court went on to the restitution principles and held that if the assessee has already repaid the refund, he should be restored to the original position wherein he would not have filed the refund. So in that case, the credit that he has utilized for the payment of GST should be restored. In our view, the judgment is correct because the taxpayer should be restored on the same position. While in our view, in this case, court did not refer to any provision in the GST law. Legally also, a taxpayer in such cases can file for refund because under section 54 read with rule 89, if any excess tax has been paid, that can also be demanded as refund. So in this case, it tantamount to excess payment of tax. So assessee could file a refund application also under GST law. Moving to next judgment, so this was a jurisdictional issue case. The petitioner challenged the show cause issued by a state tax officer as his jurisdiction was under central tax officer. The court held that under section 6, both state tax officers and central tax officers become qualified proper officers. So there is no inherent lack of jurisdiction, and the division of taxpayers is only done for administrative convenience, which is very well coming from the GST Council minutes, that this division is only for administrative convenience, and otherwise both the officers have the jurisdiction. So on this basis, the court held that the proceedings cannot be nullified even if it is raised by the state tax officer. In our view, the judgment is correct as both the officers have the jurisdiction and section 6 specifically provides for the same. So to that extent, proceedings cannot be nullified. Now moving to advanced rulings that have come up under GST. In a Maharashtra Advanced Ruling Authority, the case went to the authority was with respect to incentives. So in this case, the applicant's original equipment manufacturer OEM was located outside India and it was receiving performance incentives from that manufacturer. The interesting part was that goods were purchased from Indian distributors of the OEM and not by the OEM itself. So assessee was claiming that it should qualify straight discount. However, the AR held that it cannot qualify straight discount because it cannot be related to the purchases, as purchases have not been made from the OEM. And so to that extent, if OEM is paying any amount, that would be considered as for a consideration for supply of services. That could be marketing services. So to this extent, AR has rightly held that this will not amount to trade discount because you cannot establish the nexus with the purchases. The AR further went on to hold that place of supply of these services would be India under Section 13(3)(a) because of performance-based services. So it held that marketing services are supplied in respect of goods made physically available by the OEM to the service provider. We differ to this view because for provision of marketing services, physical presence of goods is not a necessary element. So to that extent, this should qualify under the general rule and it should qualify as export of service. The next ruling was in the case of Crystal Crop. So again, this was an interesting issue. The assessee was merging two GST registrations. So it had registration in state A and state B. So it wanted to merge both the registration and state B. So it applied for transfer of credit through ITC 02. So applicant was asking if it can treat it same as the transfer of business and thereby supply of service, and then transfer the credit through ITC 02. The AAR held that since these are two distinct persons only and not another person, so it will not amount to transfer of going concern to another person. Hence, it will not be a service but a supply of goods. Further, in respect of transfer of credit through ITC 02, also the AR denied the transfer on the ground that merging two registrations of same legal entity will not change the constitution of registered person. In our view, the ruling is incorrect because firstly, when the law itself deems two registrations of a person as distinct persons, so transfer of business from one registration to another registration would tantamount to transfer of business by way of going concern. And secondly, change in constitution of registered persons should be read in a constructive manner. And even if the business is getting shut in a one state, it would amount to change in constitution of that registered person. So ITC should also be allowed to be transferred to ITC 02. Now coming to some other rulings, some CSTAT rulings. So as we all observe that even under GST or under service tax, the authorities are taking this recourse that basis the income tax authorities' reports, documents, investigations, they are directly raising demands with respect to service tax or GST. There have been several rulings to this effect, and this was the one ruling CSTAT Ahmedabad, wherein the CSTAT has held that just based the income tax documents, the department cannot raise SCM. They have to have their own investigation and reach to a conclusion to raise an SCM. Next is the case of CSTAT Ahmedabad in the case of Shell Energy. So this was a case of unjust enrichment, and the topic of unjust enrichment is normally undermined by the taxpayers, but the courts have been consistently denying refund on the ground of non-satisfaction of unjust enrichment test. So in this case, what was happening was that the taxpayer paid the tax and created a receivable entry wherein it made the government as debtor. So as long as it created a receivable, it was fine. But correspondingly, it also created a provisional entry in the P&L to the effect that in case this is not recoverable, it will amount to cost. So the CSTAT held that by creating a provisional entry in P&L, ultimately you are adding on to the expense and the cost, which would become the cost of the product, and ultimately you will recover it from the customer, and so the unjust enrichment will get attractive. So it denied refund to the taxpayer and ordered it to transfer to consumer welfare fund. In this case, we would like to highlight that whether all these parameters as to whether you are creating a receivable entry or you are making a provision, etc., are indicative parameters, but the ultimate test is whether the tax burden has been passed on to the customer or not. So there is a Bombay High Court judgment wherein the taxpayer had expensed off the tax cost, and then also it proved that it did not recover it from the customer. It did not make part of the cost of the product. So in that case, the unjust enrichment test was satisfied. So while all these are indicative parameters, but ultimately taxpayers have to prove through various evidences that they have not passed on the burden to the customer. Last ruling is with respect to what qualifies as imports or raw material. So this was the issue where the department was denying credit on welding electrodes on the point that these are used only in the process of manufacturing but are not part of the end product, finished product. So the High Court referred to the famous Balar Industries Supreme Court judgment and held that it is a settled principle that whatever is used in the manufacturing process qualifies as raw material, and it does not have to have does not need to go into and be found in the end product to qualify as raw material. So in this case, the assessee was dealing in the manufacture of prefabricated structures. So welding was an inherent process that was required. So welding electrodes were getting consumed in that welding process. So particularly they were not forming part of the finished goods, but since it was an important essential element of the manufacturing process, so the chief had allowed this credit on welding electrodes basis the settled jurisprudence. Moving to the synopsis, so we'll just sum up the entire session. As we saw that various relaxations and timelines have been introduced under APCG scheme, so taxpayers have now more liberal standpoint in respect of if they want to extend the EO, they can even till 8 years they can file for the extension. Earlier it was only 3 months to 6 months. In respect of illegal matters, we discussed that high courts have been giving relief to the taxpayers that in case of inadvertent errors where there is particularly no evasion of tax, then penalty should not be asked from the taxpayer under section 129(3). Then we saw the Supreme Court judgment wherein it said that if statute provides for a particular interest rate, it should be paid on that rate only and not beyond that. In the High Court judgments, we saw that if multiple investigations are being raised on the taxpayer on same subject matter, they can contest it as that is an unfair practice by the department side. If any, this was one relevant case for taxpayers where they refund back their erroneous refund. So they can very well claim back their ITC either through filing of refund under section 54 or through restitution principle. Then we saw that just basis the income tax authorities information, service tax department or GST department cannot raise direct demand or issue SCN. In respect of unjust enrichment, we discussed that creation of provision entry will hit the PNL and will then become part of the cost of the product. So courts have been denying refund basis the unjust enrichment test in such cases. Lastly, we saw that even if goods are not directly getting into the finished products but are getting consumed in the manufacturing process, even then they qualify as raw material and eligible for credit. Stay tuned for our next roundup in next month. Thank you.